From the Lineweaver Wealth Watch Center, this is the Financial Quarterback.
I'm Jim Lineweaver, your financial quarterback since 1993. Recently, we've been hearing from people who have been enrolled in Social Security, but seeing their taxes go up and not understanding why. So today I'm joined by LFG Tax Director Mark Sipos to explain the reasoning behind this and how you can be proactive to try to help you minimize this tax bill. So Mark, what's really kind of going on in this situation?
Thanks, Jim. As most people know, some of your Social Security benefits could be included in taxable income. In fact, depending on your household income, 85% of those could be included in your taxable income and have tax generated against them.
Yeah, and other things like 100% of your withdrawals from any traditional IRAs and 401ks will likely be considered taxable income as well.
That's right, and we try to help manage the withdrawals with our clients by working with them closely to make sure that we try and keep them in the same tax bracket. But what we've seen recently is an increase in taxable income because our clients are taking advantage of the higher interest rates and investing in CDs and money markets.
Yeah, and the interest on these are taxed at the same federal income tax rate that you had back when you were working, which might be twice as high as what you can get in other types of instruments and other opportunities that are out there.
Exactly, and that's why it's vital to collaborate with your tax professional and try and come up with a strategic plan to mitigate those sudden increases.
And also on the horizon, the Tax Cuts and Jobs Act of 2017 is set to sunset on January 1st, 2026, which could actually cause a further problem in all this.
That's right. I mean, when that act sunsets, all the tax brackets will increase in tax rates back to the old prior to 2017 rates, which were much higher, as well as losing some deductions. For example, the standard deduction will no longer be doubled. That could be at least a $12,000 loss of a deduction for a married filing joint couple.
The act also doubled the estate and gift tax exclusion, so without any new legislation, it will be cut in half from $24 million down to $12 million. Mortgage interest deductions will be restored to the $1 million in debt before any phase-outs, and home equity interest deductions also going to be allowed all the way up to $100,000 again.
And with the Fed potentially decreasing interest rates in the near future and the sunsetting of that tax act we mentioned, there's a lot of changes coming down the pipeline that we need to not only be aware of, but start planning for right now.
So thanks, Mark. Even though it feels like we just got out of tax season, it's never too soon to start prepping for the next season. And when it comes to interest rates, the clock is ticking, and if you wait until they lower, you'll miss the opportunity. So at Lineweaver Financial Group, we take a holistic approach when it comes to your finances, so our experienced professionals can help you coordinate all your financial, tax, legal, and wealth management plans. So call us today for a no-cost, no-obligation meeting to help prepare you for what's to come. Stay tuned for Fox News Sunday.